I got a joke for you. Two economists are walking down the street. One of them says to the other, "Hey, look, there's a $100 bill just lying there on the sidewalk." The other one says, "No, it can't really be there. Somebody would have picked it up." That, in a nutshell, is the way economists believe markets work and the way they model them. It's the efficient markets hypothesis. The model doesn't allow for excess profits to be lying there easily taken with no effort, but as we will see today, that's sort of what exists in the apartment market right now and for the next couple of years. More on that later. I'm Brad Hunter, founder of Hunter Housing Economics, a company that does market studies nationwide, but we're based here in South Florida. By the way, I didn't always want to be a housing economist. I just didn't have enough personality to be an accountant. The apartment market is rough right now, but it's not going to be like it is today for much longer. In fact, I see what could be a generational opportunity for investing in and developing apartments. We're already seeing new deliveries slowing and demand high enough to keep up for the most part. We just talked with a developer client of ours who we did a study for in West Palm Beach who said that they're leasing extremely well today at rents that are right at the levels we predicted in our study. And 2 years from now, the market's going to be much stronger than it is today. Here's the point. The big money is made when you bet on a turn and you get it right. There is a turn that's just beginning to happen. The writing's on the wall. We know what's happening with supply. We know that total aggregate absorption in apartments has been very strong. Almost all the units that have flooded onto the market over the last couple of years has gotten absorbed. Now, granted, that's at the expense of some major concessions in a lot of cases, as filling in the building takes precedence over sustaining high rent levels. But looking at a key indicator of demand, which is household formations among renters are driving all of the household growth. Household growth among renters is very strong. This is the key driver of demand for new rental units, which can be apartments or BTR. Now, will growth continue to support that level of growth? Will consumer confidence be there to support that kind of growth in households? That remains to be seen, but all that being said, apartment demand is elevated because of the cost of owning a home. Mortgage rates came down a bit, but the Fed's cuts only affected the short duration end of the yield curve, and it's not clear that mortgage rates will come down a whole lot further. Meanwhile, home prices remain inflated after COVID and remain very high. Now add another demand boost for South Florida, which is the prospect of higher corporate and personal taxes for upscale individuals in New York City. Will it be a million who move out of New York City? Maybe not, but could we expect 100,000, 200,000 to move to places outside of New York? That's easy to imagine. Another point about demographics and demand, the Harvard Joint Center for Housing Studies shows data that Gen Z is rapidly starting to overtake Gen Y, the millennials, as the key generation driving apartment demand. So we start to see millennials tapering off and Gen Z just rocketing higher. So the demand side is looking good. The reason for the apartment market being problematic right now is supply. There's been a huge number of deliveries because of the high deliveries. That's pushing down rents. It's slowing down per project absorption and leasing paces, but the writing's clearly on the wall. They say forecasting is hard, especially when it involves the future, but this is one thing that's actually pretty easy to forecast. We know that starts for multifamily properties are down in round numbers 50%. That's just in the last year. Completions are down about 50% as well, as shown here by Yardi. The other major data providers that track the projects and what their completion dates are going to be will show you the same thing. There's going to be about a 50% decline in completions between today and 2027. So if you bet now, are you a contrarian? Yes, but I think it's a smart contrarian bet, an obvious one even. There's an old saying that when a novice investor makes a mistake, it's because they missed the nuances. When a pro makes a mistake, it's because they missed the obvious. And that takes us back to that joke about the two economists. They just keep on walking and leave the money down there. But the moral is don't miss out on an opportunity because it seems like nobody else around you is acting yet. I think the players that place the bet at the early stage of the cycle, which is, I think, where we are now, are going to make outsized returns. Of course, if you're taking greater risk, you demand higher returns. Rents always rise in the summer, except when they don't. And this year was a don't. The supply situation has been oppressive and it's taken its toll on rents. There are some positive signs. Retention rates are high. The rent to income ratios are still looking very promising, and the household formation rates for renters are very strong, as we talked about. So, all that to say, even if demand softens with the economy, we'll see substantially more demand than we're going to see deliveries in 2027. Renters are seeing much faster growth in their incomes than the population at large, which should allow for rent growth once the supply clears. The other positive on the demand side is that renters who are signing leases are often choosing longer than normal lease terms, which you wouldn't find happening if renters were too nervous about the economy. In 2027 and 2028, we'll see such a drought of new deliveries that unless something terrible happens to the economy, we'll see an outstanding opportunity to open into that void. I'll also add that you have to be careful when you think about the occupancy data and how you interpret it. Total occupancy is improving a bit as the huge number of new completions that we've seen recently work through the lease-up stages. But stabilized occupancy, that's excluding the new projects that are opening, that number did decline a bit in the third quarter. So we're watching that. And that plays into what we were talking about with the rent slump. This also is affected by operators who are incentivizing longer lease terms in order to protect occupancy. And we're seeing that in almost every rental study that we do. The dry powder is starting to activate, but it's still early in this process. I believe that people who begin to activate now to take advantage of this opportunity, which is really a generational opportunity, are still going to find that they're getting in at the right time. Purchases of multifamily assets are up, but only about 1% or so, so the turn is just beginning. Groups are buying assets in Dallas, Seattle, and South Florida. South Florida is among the most active sales markets right now, but it's still early days. There's some funny phrases being used. We used to hear stay alive till 25, then it'll fix in 26, and it'll be heaven in 27. We're getting a little silly with these kinds of statements, but when you look at the numbers, it's pretty clear that there really is a unique opportunity here. Now, if you expect a recession, then you'll be, of course, a little wary about projecting strong rent growth. But if you expect steady economic growth, even slow economic growth like we're in right now, then you probably expect concessions to at least partially burn off in 2026, picking up effective rents to some degree. Just a partial concession burn off would lift the effective rent numbers and show a better scenario. There are certainly some regional differences that you have to take into account. A lot of Miami submarkets are still digesting supply, but of course, the long-term story in these markets is strong. That said, I think you have to be smart about positioning. If everybody goes after the same group of tenants, then we run into a problem. If in this next wave there's proper stratification, a good amount of diversification, then I think this next cycle is going to go well. It's not a no-brainer in that the 50% drop still leaves a fairly large number of completions happening, a fairly large number of starts still happening. But when you look at the market rate apartments specifically, especially Class A, the drop in completions is going to be very dramatic. In our company, we do site-specific market studies, and it's all about looking at the specific local market supply-demand situation, understanding the comps very well, and then portraying that to your capital partner. So to summarize, the real money is to be made through anticipating the next change, particularly here in South Florida. Looking at data on where we are today will only get you so far. Reading the signs that are very clearly saying that we're going to be in a very positive supply-demand environment in the next 2 years, and drilling down to the submarket level to see the expected future deliveries in that area is the key to capitalizing on this opportunity and making a lot of money. The investors want to see all this laid out quantitatively and realistically. So that's what keeps us busy. We've done an analysis at the county level in South Florida of the supply and demand conditions in the South Florida submarkets. We've observed that there are some particularly strong opportunities in Palm Beach County, where our calculations show a shortfall of new supply to the tune of 4,188 units per year in 2027 and 2028. This is bolstered by the explosion of the financial services and medical sectors and a relatively small number of new apartments supplied compared to Broward and Miami-Dade. Companies like Goldman Sachs, JP Morgan, Citadel, Anshin, Colony Capital, Elliott Management, and others are driving demand for the $3,000 to $4,000 a month apartments there. So always remember there are three kinds of economists, those that can count and those that can't. With that, we'll see you next time. Thank you.